into the trading plan here. So before we talk about the actual nuts and bolts and ins and out of the trading plan, I want to talk a little bit about the philosophy and motivation behind all of the trading plans that we put together here at keenonthemarket.com. Well, all of the trading plans that we put together are based around this idea that the average retail trader, for whatever reason, is not successful. Okay, and it's really quite startling when you come to the realization that the vast majority of retail traders out there are losing money in their accounts as active traders. As a matter of fact, 9 out of 10 retail traders in the long run will lose money and be unable to turn a profit at all when trading. In fact, 18 months is the average lifespan for an active retail trader's trading account. So that just goes to show you that it's a tough game, right? But what is it that makes it difficult for retail traders? Well, one of the main challenges that I think is that there's a lot of resources out there available to retail traders that want to learn more about trading, but they don't necessarily address the main issue or main difficulty that retail traders have, and that is overcoming their own way of thinking and some of the mental barriers to being successful at trading. So unfortunately, it's human nature to instantly and truly firmly believe your first instinct. So if I think that a stock is going higher and I buy it, as it moves lower and moves against me, my brain is going to tell me that I should keep buying it because my first instinct is the one that I'm going to want to trust the most, right? And the same thing goes for a stock that I am short that continues to move higher. Your first instinct always feels right, and it's kind of counterintuitive to train your brain to, operate in a way that is, effective for trading because, it's kind of counterintuitive. So only 1 in 10 traders is profitable. So all of our trading plans focus on ways that a trader can get into higher probability setups, okay? And one of the things that we're going to focus on here is how I can follow institutional order flow to increase my odds of success, okay? Because like I said, retail traders have trouble trading, okay? Retail traders have trouble. They statistically are not successful. Institutional traders, however, it's a completely different ballgame. They typically make money, right? They typically are successful. So what is it that they're doing, or what is it that they have that I don't have or that retail traders don't have that add to that success? So I like to take a look at the unusual options activity trading plan as a view into the world of an institutional trader. So if I can trade more like a big bank, if I can trade more like Goldman Sachs, or I can trade more like Citigroup or Bank of America's prop desks, well, then I think that gives me a big advantage over retail traders who don't know how to do those things. So it all starts with unusual options activity. So what is unusual options activity? How many people in here right now would consider themselves active equity options traders? How many of you would consider yourselves active equity options traders? Maybe you only make 1 or 2 equity options trades a month, but I would still say that would qualify you as an active equity options trader. So how many of you in here would consider yourself active equity options traders? Okay, and maybe for those of you that wouldn't consider yourself, so yeah, Steve, you consider yourself an active trader. A couple more of you say yes. But how many of you, those of you that say no, why is that? Why do you tend to shy away from the options market? Well, options can be a little bit intimidating, right? They have natural inherent leverage that makes them risky if you don't understand how to harness that leverage and use it in your advantage, all right? But one of the most difficult things about trading equity options as a retail trader is managing all of the moving parts that you might have in a large book of options, right? There's 6 components to the underlying components to the price of an equity option, and the price of the stock is only one of them. Okay, so it's a more complex product that requires a little bit more knowledge, but what is really kind of, I think, difficult for a lot of traders who don't trade options to wrap their head around is the idea of, hey, how come I can buy calls in a name, see the name go higher, and then lose money? That doesn't make sense to me, okay? And that's because you're probably doing something wrong along the way, right? You're picking a strike that's too far out of the money. You're buying too much implied volatility. But keep in mind that institutions, when they're trading options, they have whole teams of people dedicated to doing their research for them, selecting their trades, and executing those positions. So we try to find the most unusual or the most suspicious of these institutional order flows. So unusual options activity is driven by institutional order flow. Unusual option activity is an order that is above the average daily volume for options in a given stock. So to put it simply, if a stock on average, if I have stock XYZ and on average it trades 50,000 options contracts a day, if I see an order for 60,000 contracts, that is unusual options activity, okay? And in a lot of names, it's much smaller. A stock might only trade a few hundred options a day, and then if I see an order for 5,000 options, that is unusual, okay? But what these orders do is give me insight into institutional order flow and lets me see, as a retail trader, where the quote-unquote smart money is going, okay? A lot of people focus on inflows and outflows, and really in the equity options market, there's no way to really do that unless I am able to follow this unusual option activity, okay? And all I need, right, is access to the tape. All I need to see is the execution of these block trades hitting the tape. And that might sound easy to do, but where the difficulty and the art in it lies is that I have to determine which of these orders are speculative, which are hedges, and which would actually be considered unusual activity, okay? Because a lot of orders hit the tape in a day, guys. If you try to watch the time and sales window for just one stock that trades heavily in options, you'll see thousands of orders hitting the tape in a day, okay? So I have to sift through all of those orders across the entire stock market, and keep in mind there's over 4,000 optionable stocks out there to find these orders that are suspicious or are unusually large, that are indicative of a trader out there or an institution who has a very strong opinion or knows something that I don't, okay? So what types of trades can I see hitting the tape that are being made by institutions? Well, a trader can buy calls, and that can be a hedge or speculative bet, right? Not every order, big block trade of calls being bought is being put on as a bullish position. If I buy calls, I might be buying those calls as a hedge against a short stock position that I have. If I'm selling calls, it's not necessarily a bearish position. It could be protection against a long stock position, where I'm trying to create an extra dividend stream, or it could be speculation to establish a short position. Same thing goes for puts. If I'm buying puts, is it more likely that I'm speculating on a stock moving lower, or is it more likely that I'm hedging myself? Okay, these are all the questions that I have to ask myself every time I see an institutional order hitting the tape, and we're going to talk about how I can go through and make a determination or a best guess of whether or not they are hedging themselves or speculating, right? Because I don't want to buy their hedge, okay? Yes, this webinar is indeed recorded. So, I don't want to be buying institutions' hedges, okay? I don't want to buy calls in a name that they're short stock in, because their actual view of the stock is that it's going to move lower. So I have to filter out and determine which of those trades are hedges and ignore them, okay? So any trade can be speculation or a hedge, so I need to determine which scenario is more probable, and we're going to go over a big list of things that I can do to help make that determination. Okay, so it really kind of breaks down like this. I can't take trades at face value. Every time I see a large block of calls bought, only 70% of the time is it actually bullish. And you can take a look through these here. I mean, selling calls you would expect to be a bearish order most of the time, but about half of the types of strategies that traders use that for are to create extra dividend streams in the name. Same thing goes for paper buying puts. The most of the time, it actually is not bearish speculation when we see paper buying puts. And when I say paper, paper is a term from the trading floor and from the pits that refers to a large institutional trade, right, when orders would come in on cards on actual paper. Okay, so if that was confusing, I'll clear that up for you guys now. All right, so in fact, institutional traders use all kinds of strategies to hedge positions and make speculative bets. Trades are not necessarily what they seem. So in order to dissect unusual option activity, I need to have a fairly solid knowledge of equity options and of how equity options tend to trade in the market, especially by institutional players, okay? So what does unusual option activity look like, right? What does it look like when one of these orders hits the tape? Well, I have here is a snippet and screenshot from a scanner piece of software that we use called Trade Alert. And what Trade Alert does is it scans every single equity option exchange in the country for block trades and then spits them out to me in a feed that I can see and read throughout the trading day in real time. Okay, so as soon as an order hits the tape, I see it in my Trade Alert. Now I apply filters to filter out a lot of the noise, but this is how I see this order flow. So here we have an example of an order hitting the tape. There's a lot of information in here. What exactly am I seeing? Well, I can see what time the trade hit the tape. I can see whether or not the trade was initiated as a buy or a sell. Green tells me it was bought, red would tell me it was sold. I can see how many they bought or sold. I can see the ticker, the expiration, the strike price, if it was a call or a put, the price it traded at, and what's even more important is the exchange bid and ask at the time of the trade. So I can see what the best market was when they put this trade on. So when I see this block of calls being bought in ALTR, I know that the market was 25 cents 25 bid at 35 when they took the trade. They paid 35 cents, so I know that they paid the offer, which means it's a little bit more aggressive. They aggressively bought these calls, okay? I can also see whether or not the trade was an opening or closing position and where the stock was trading at the time of the trade. Now, all of that is information that I'm going to be using in the actual trading plan. But before we get to that, let's talk a little bit about how these trades are actually executed, because it is important to understand how these trades are actually executed to understand the trading plan. Okay, so the institutions will create an order based on research, information, and analysis. So keep in mind that it's just a sheer question of manpower when it comes to the type of research that I can do versus the type of research a hedge fund can do, right? It might, I can spend 8 hours a day after the market closes, after trading all day, doing research and looking at charts, poring over data, doing statistical research, but no matter how much time I spend, I'm still only going to be one person doing that, right? So I'm limited in how much research I can do in the by the simple fact that I'm only one guy, right? I can't spend 24 hours a day going over this stuff and doing analysis, right? But hedge funds have entire teams of people. Options desks at big banks have entire teams of people that work all day long on generating this trade idea. Okay, so I automatically know that every time an institutional order hits the tape, the sheer amount of man hours that has gone into the research, analysis, and execution of that trade is something that I could never even approach in my own trading as a retail trader. Okay, so once they've gone through this, very laborious and man-hour intensive process of determining what trade they want to put on, they will call their brokerage to get the trade executed. They might shop the trade around to different trading desks like Citadel, Goldman Sachs, Barclays. If they don't get filled on any of those, then the order will go to the pit and the market makers can trade it. If not, the trading desk outside the trading pit will execute it, and the firm might take the other side of the trade themselves and hedge it however they see fit, or just take the risk. Regardless of where the trade takes place, whether it's upstairs, off the floor, on the floor, that order must be reported, right? It's a public market. I have to see, or at least have the ability to access all of the trades that are coming across the tape. It's public information, okay? So all of the time and analysis and work that a hedge fund or institution might put into establishing a position or coming up with a trade idea, as soon as that order hits the tape, I can use that order as information however I want. It becomes public information at that point. One thing that people really pore over unusual option activity to try and find is trades that are made that might look like a trader has some type of insider information that is non-public. Okay? Now, what is something like that happens? All right, and we're going to look at two examples of a case where I would, bet money that was the case, where a trader executed an options trade with non-public insider information that they weren't supposed to have. Okay? Regardless of what they know, what they don't know, and how they obtained their information, whether it was, against regulations or not. As soon as that order hits the tape, if I can recognize it as a suspicious order and I then take a trade based off that order, it is public information and I have done nothing wrong. Okay, so there's a lot of people that try to look for this type of order flow to find stocks that are, looking like they have some kind of suspicious options trades ahead of what might be a takeover announcement, right? And we're going to look at two examples of that exact same thing. Okay, so does anyone have any questions so far about this an order equity option order process, or what would actually constitute an unusual options activity trade? We're going to look at some more examples here, and maybe it'll become a little bit clearer after that. But if anyone's completely lost, please let me know now, because I'd be more than happy to go back and cover some of the other stuff that we already talked about. If not, I will continue to move forward here. It looks like you guys are pretty well absorbing and understanding everything, so let's go ahead and move on. So let's take a look at a couple of examples of unusual option activity, and let's go back to this ALTR example here. Now, who here has ever traded this stock? Who here has anyone ever traded Altera Corp? Okay, has anyone ever executed a trade in ALTR? Kind of one of those stocks that you might consider a trader favorite, especially on the equity option side, because the stock tends to move a lot, tends to have a lot of rumor and speculation around it. So it's one that moves. It's an interesting stock from a trader's perspective. So when I see this type of order hitting the tape, and one thing that you'll notice is that ALTR actually does not trade very much options volume in a day. Okay, it's on the lower end, but I see this type of order hitting the tape. This trade hit the tape on March 27th with less than an hour to go until the close. Shortly after the trade hit the tape, the stock was halted and ripped higher on M&A news. Now, I don't even remember what the news was. The news was that someone was coming in and making a potential bid on ALTR, the company Altera, and the stock ripped higher. Okay, look at the chart into the close and then through the open on Monday to see how the stock traded after this news, and also remember, after this order hit the tape. This order hit the tape before the news came out. And this did hit our equity option scanner called Option Hacker that looks for these types of trades. So after these calls hit the tape, you can see a huge move higher in Altera. These calls hit the tape in this bar here. The stock was halted right here for news pending, and then when the stock reopened, it ripped higher and traded up to the highs here above 44.5 here, almost $45 to the upside. Okay, now is it possible, or does it seem suspicious that this trader who executed this trade put on all of this risk in front month options moments before some type of material news was released to the public? Right? Of course it's suspicious. Did this person who executed this trade get a phone call from the SEC? Probably, right? This is a very suspicious order. Why would someone do a trade like this unless they knew there was going to be some type of news? Now, maybe this trader can say that he just got lucky. Maybe that defense will work for him. But to me, it doesn't really matter what he knew, how he found out, or when he knew it. All that matters to me is that I saw the order flow hitting the tape, recognized it as being suspicious, and was possibly able to execute a trade based off of that order flow. Okay? Once that happens, there's literally nothing that can happen to me after that. A lot of people look at this and say, is this considered insider trading? Absolutely not. All unusual options activity and all equity options orders that hit the tape in a given day are public information. Okay? So as soon as that order hits the tape, I can make a trade based on it. I can do whatever I want with the information that I have gleaned off of seeing an order hitting the tape like this. Take a look at how the stock continued to rally through Monday. Well, the stock continued higher on Monday, and these calls exploded in value, trading as high as $7 since they were bought. If a trader bought 20 of these, risking $700 total in the trade, they would have profited $13,300 at the highs. This is an amazing example of unusual options activity ahead of M&A deals. There was a study published last year, and I believe it was published by a research group, but it was brought to light when Andrew Ross Sorkin, a very renowned financial journalist, wrote an article about how it was proven that ahead of M&A deals, about 30% of them have some type of unusual options activity ahead of the deal being announced and made public. Okay, so what does that tell you? That tells me that over a third of M&A deals, or around a third of M&A deals, have some kind of leading or telegraphing unusual options activity. So if I'm able to recognize what that activity looks like ahead of a deal, well, I can catch some amazing, amazing returns. I can tell you guys the largest profit that I've ever made on an M&A deal was because of unusual options activity. It happened about a year and a half ago or so when Cisco, which is a large food company, was being talked about or announced that they were putting themselves up for sale and a potential M&A target. The stock ripped higher on Monday after we saw unusual option activity on Friday, just very much like this ALTR case. And on roughly, $400 worth of risk, I made $13,000 overnight. Okay, now that's not your typical unusual option activity trade. If I'm lucky, I might catch 4 or 5 trades like that a year, or there might be 4 or 5 trades like that a year, and I'm lucky to get into 1 or 2 of them. Okay, now this next example in Kraft, we all know what happened with Kraft after they announced the HNZ Heinz acquisition. This is one that people in our trading room, a ton of them got this. I mean, this was an amazing, amazing example of unusual options activity. Well, what happened was on March 10th, a trader bought 10,000 Kraft June 67 half calls for 70 cents. Okay, so go back to March 10th. Where is that on this chart? March 10th is sometime, in this region here. I don't know exactly, but it's, in between the beginning of March and the 16th. The trader came in and bought 10,000 of the June 67 half calls with stock trading around 62 bucks. Okay. Then the announcement was made that Kraft would be acquiring HNZ, creating one of the largest food companies in the entire world, and that on the acquisition they would be paying their shareholders a special $16 dividend. Okay? Stock exploded to the upside and continued higher after that. Now, after this trade hit the tape and after the announcement came out, these calls traded as high as $22.70. Okay? $22 higher than what this trader paid for them. Okay? That's $44,000 profit on a 20 lot. How much is my risk in a 20 lot? $1,400. Okay? This is an example of a massive, massive trade ahead of a, huge M&A deal announcement. Because this trader didn't put on a small amount of risk, right? I have to understand that to put on 10,000 of these calls for 70 cents, they had to invest $700,000 in capital to put on this position, right? They had to put on a huge, huge chunk of change to get long these, right? That's a lot of risk to take for anyone, for any institution, okay, especially in equity options. So, this reads as very much like they knew something ahead of time. Many, many, many of our traders in our trading room took advantage of this signal and bought these calls. And there were members of our trading room that had on, a 40 lot, a 50 lot, a 100 lot, a 200 lot, and were making $100, $200, $300,000 on this trade, right? Like I said, that's not your most typical type of unusual options activity trade, right? I'm not going to see this happen to me once a week just by following unusual options activity, but what we tend to see happen more often are what we call, little smaller hits or quicker hits by following unusual option activity. Take a look at a trade that came across the tape today, okay? And this is a trade here in CTXS, okay? This hit our scanner and is flagged as unusual option activity. A trader bought 1,419 of the May 70 calls for 75 cents. Well, what happened after this trade hit the tape? We know that today was a little bit weaker of a day in the market, but after these calls hit the tape this morning, they hit about an hour and a half after the market opened. CTXS ripped higher. Take a look at how this stock moved after these calls hit the tape. Oops, sorry. Stock was trading right around this level here when the calls were bought, and the stock ripped higher from this 67.96 level to almost 69.25. Okay, now what type of profitability can a move like that produce in the options market? Well, let's take a look at what happened to the Citrix options. Well, the trader bought them for 75 cents. As the stock moved higher, the options moved higher with it. And today, these calls traded as high as $1.14. Unbelievable, right? So they went from 75 cents to $1.14 at the highs in a single day, right? In the matter of hours. So how much profit is that? Well, that's a 39-cent profit on these calls, which is $39 per one lot. So again, if I would have bought a 20 lot, that would have been almost $800 in profit in a day on a relatively small amount of risk, okay? Now, again, this is more typical. We see this happen all of the time, right? The typical case or the base case is not, hey, I buy these calls for 70 cents and they go to $30, right? That might happen every once in a while, but what is much more common is when we see a move like this. Because if you don't understand the way that equity options trade or the way that market makers trade them, let me explain really quickly some of the dynamics of the equity options market that might explain why things like this tend to happen. Well, for one, CTXS is a stock that doesn't trade a ton of stock in a day, okay? It really doesn't trade that much stock. Actually, if we take a look here and see what its average daily volume is, it only trades on average about, where did this go? It only trades on average a couple million shares a day, okay? So if it only trades a few million shares a day, the size of these orders become more significant. If I buy 5,000 out of the money calls in equity options, the market maker that sold them to me must go buy stock to hedge himself, okay? So two things happen. One, he has to buy stock to hedge himself. He or she has to buy stock to hedge themselves. When markets are thin, this can cause the stock to move higher very quickly. The second thing that happens is that as I am buying, as a trader who is buying more and more of these options, it pushes implied volatility higher. So I can make money two different ways, either by the stock moving higher or by implied volatility moving higher as more and more options trade. Implied volatility can be viewed as what the projected move in an underlying stock might be going forward, or it can also be viewed as the supply and demand curve for equity options. So the higher the demand for options, the higher we see implied volatility go. Implied volatility is one of the underlying components of an options price. Okay, so as large orders hit the tape, when I see this big block of CTXS calls being bought by a trader out there, somewhere out there, I know that his order is most likely to push implied volatility higher. And all of the orders that follow him are likely to do the same because the market maker will see the demand for these options increasing and therefore raise the implied vol. Okay, so does everyone understand those two things, those two kind of mechanics of how the equity options market works? Because now we're going to jump into the actual trading plan, meaning once I see this type of order hitting the tape, how do I click the mouse, right? What do I buy? What are my targets? How do I actually execute these types of trades? So it's kind of important to understand the underlying mechanics of why they work before I can talk about exactly what it is I do when I see these types of orders hitting the tape. Yes, clear, makes sense. So does anyone have any questions? Is anyone completely lost? Is anyone completely lost? I could use some clarification. Good, okay. So, just a quick recap of why these orders are important before we jump into the trading plan. So why do I want to take these trades? The hedge funds and big traders have much more information than us. That's why they're always getting in trouble for having insider information, right? Because they have better access, right? If I am the manager of a $20 billion hedge fund, am I, trading with, a whole team of people and the best technology that money can buy and the best data sources that money can buy and the the personal connections that I might have that money can't buy, right? These are all things that as a retail trader at home or even trading from an office, I don't have access to, right? The sheer size of institutional players and the capital that they have access to gives them an inherent advantage just because they're able to afford better technology, they're able to afford more research, they're able to afford more people to do their work for them and find the best possible trading opportunities in the market, okay? It's like being able to see what Carl Icahn or David Einhorn are doing before they have to disclose their positions. I can tell you guys that during the first couple days, the first days and weeks of the Bill Ackman, Carl Icahn war over HLF, we were able to see all of their order flow hitting the tape and identify not necessarily who it was, but that someone out there with a lot of capital was coming in and putting on very large bets in HLF. As Ackman rolled his short out, as we were coming into the beginning of this new year, as he rolled his short in HLF out, we were able to see that happen, and we were able to determine that it had to be him doing it because no one else would be trading in that size long before he actually disclosed or it told the public what it was he was doing, and long before CNBC, Bloomberg, Fox Business, or any other news outlet was reporting that same fact. Okay, so one thing that you need to understand that is very important to trading this way is that all of these trades that hit the tape, every single one of them that comes across is public information. Public information that I can do with whatever I please. Once I determine what the order is unusual or suspicious, I can place any type of trade I want based on that order flow. Okay. So with that being said, let's jump right into the trading plan here. Okay. So let's take a look at an example here of some unusual options activity that hit the tape. And we have a trading plan. It's just kind of a method of analysis for going and looking at unusual options activity trades and determining whether or not it's something that I want to risk my own capital on, okay? So I have a trading plan that I call the OCRRBTT trading plan, and actually it wasn't developed by me, it was developed by our founder and head trader, Andrew King. But take a look at this order that hit the tape here. The NTAP May 36 calls here trading for 69 cents. Now, what makes this order unusual? Well, first of all, we take a look and we see that the market was rather wide when this order took place. The market was 56 cents at 71 cents. And let me pull up the pen again here so I can. The market was 56 cents at 71 cents, and I hate this color because I can barely see it. So give me 1 second here, guys. Let's do this one. So the market was 56 cents at 71 cents when this order hit the tape. Okay, they paid 69 cents, meaning that they paid pretty much close to the offer here, right? So that's an aggressive buy. They could have tried to work an order somewhere in between here, but they didn't want to, right? They just wanted to get in at whatever price they could. Also, they're buying 3,845 of them, all right? So I automatically know that this is a rather large institutional trade because with this much risk, buying that many at 69 cents, they're risking well over $250,000 in this trade. Okay, I also see that just by the sheer nature that it is hitting my scanner, that it is 3 times the average daily volume. So this order in NTAP showed me that on this day, NTAP was trading 3 times the average daily options volume. Okay, so that's something suspicious, right? When there's that much volume, I know that there's something going on, right? I might not know what, I might not know what this person knows, what this trader that had this $250,000 or $265,000 to risk in this trade knows, but I know that there's something going on, right? It is suspicious. So then I have to determine whether or not I actually want to risk some capital in this trade, okay? So we have some steps that we follow. And the OCRRBTT trading plan is an acronym, and you'll see that each letter stands for something here. But let's take a look at how we do this type of analysis. The first thing I want to look at is volume greater than open interest, okay? If I see that volume is less than open interest, so what I want to see is that volume, get the pen back here, is that volume, this number, is greater than open interest, this number. Okay, why is that? Well, if volume is less than open interest and a trade is not labeled opening like this, well, then I know that it's more likely that the trade is a closing position, okay? it's more likely that the trade is a closing position. I don't want to be buying a call option when a trader is selling it, right? When the institutional trader is getting out, I want to take his entries, not his exits, okay? So if I see that volume is greater than open interest, then I know that it has to be an opening position, okay? Because there simply wasn't enough open interest on that line for this to be a closing position. The volume's too big, okay? So I know that volume is greater than open interest. If it's less than open interest or the trade is not labeled opening, then I know that the trade could be closing. It doesn't necessarily mean that it is closing, but I know that there is a much larger likelihood that it is. So I want to avoid the trade. If volume is just barely over open interest, then the trade becomes less attractive as well. I want huge volume over open interest, and I want to trade opening orders only, okay? So this is a very easy and very quick way to determine whether or not a trade is an opening or closing position being put on by an institutional trader. Next, a chart. I need to determine if a stock is bullish or bearish on a chart. This helps me determine if the order is a speculative bet or a hedge. I can never know for sure, but I want to use the chart to help determine this. My main indicator is to use the chart with the Ichimoku cloud. I use this to determine if an order is a hedge or a speculative bet. So take a look at NTAP here on a chart. For those of you that have no idea what all of this shaded areas and lines are, this is called the Ichimoku cloud, and it's pretty simple. Anything trading below this is in bearish territory. Anything trading above it is in bullish territory. So this is where the only real bit of discretion falls into this trading plan, because as we look at NTAP on the daily here, you know what? It's not that really that bullish looking of a trade, right? It doesn't really show me bullish price action, right? But there's one thing that I can see is that this moving average here, this green one that we see, is that we were starting to break above it when this order hit, okay? So I know that there is some momentum to the upside. This is when I can determine whether or not I want to take a trade and whether or not I should be taking the trade as a day trade or a swing trade. So by seeing this, kind of bearish on the longer time frame, but starting to develop a little bit of bullish price action, seeing some grinding of price action higher here, I know that I can take this, but as a day trade. Why do I want to take it? Because the order is so large, and it is a front month option, meaning that it expires relatively soon. So this trader does not come in and put that much risk on unless they have a very, very high level of conviction about NTAP moving higher going forward, okay? So let's see what the rest of the plan has me do here. So then I need to take a look at what my risk, reward, and break even are, and I can measure my risk in one of two different ways, really. Really good traders will ask themselves, how much money can I make if this trade works out in my favor? But really great traders will say, well, how much money can I lose if this goes against me? I can tell you guys right now an options trading strategy that will make you money 90% of the time, very easily. And I can tell you that strategy in any stock that you want. Someone name a stock, and I will tell you a strategy that will make money 90% of the time. Okay, it's actually really, really simple. All you have to do is sell 10 delta puts in that stock, and 9 out of 10 times those puts are going to go to zero, and you're going to capture the premium that you collected. However, the one time that it goes against you, you're going to blow out your account. Okay, so I still need to make sure that my risk and reward line up well, right? I can't risk $1 to make 5 cents, right? I can't risk $10 to make $2, right? I want to have good risk versus reward. They're tied together, all right? So I need to look at my risk in one of two ways, either as a percentage of my book, meaning if I have $100,000 in my trading account, how much percentage-wise am I willing to risk in one position? Typically speaking, for me, it's not ever really going to be more than 5% of my book. So if I have $100,000 in my trading account, I'm typically looking to risk about $5,000 per trade in trades that I feel confident. For day trades, it's much less, right? Then only 1 to 2% of my book. For swing trades, then it's up there at that 5% level. But I need to keep my stop losses in mind as I enter the trade. So as a beginner, I can use a 20% stop. As an intermediate trader, I can use a 50% stop. And as an expert trader, that's when I can start taking stops off, letting the whole trade ride, and making decisions on whether or not I want to add to the position if it goes against me, okay? So Time and target. This is very important. A lot of traders will watch unusual option activity trades hitting the tape and then try to tweak them to something that they think is a better trade, okay? I want to trade the exact same expiration that the institutional trader is trading. If I see a block of calls being sold after I got long them, then I want to exit the position, okay? I want to enter and exit with the institutional trader, or exit as my profit targets are hit, okay? So I never want to trade a different expiration, okay? I don't want to buy a shorter dated expiration to try and get into the trade cheaper, right? I have to remember the whole reason that I'm taking these trades, that I'm even paying attention to this order flow, is because I believe that the institutional traders have better information than I do. So why would I try and tweak the trade that they landed on? Do you know how much time and money and energy and effort was spent to select that particular strike price and expiration? So it's no business of mine to try and change it, okay? So I want to put my offers out right